Where should I invest my money? Of all the questions I get asked, this is definitely the most common. When it comes to investing or saving, there's loads of places you can put your money, and there's so many different opinions on what order that should happen in. For some people, you may want to know where to start. For others, you may have a good understanding of the basics and you want to know what's next. So let's get into it. The first step is to create some form of emergency fund. This is your safety net for unexpected expenses. Whether you lose your job, the car breaks down, or you have a medical expense. You want to have that peace of mind that you know you can cover it without having to go into debt or to sell your investments. There are general recommendations to have 3 to 6 months of essential living costs saved away in cash. Now, in my opinion, that's going to take you up to 2 years, maybe even more to save. So for me, just start with 1 month's living expenses. It could even just be saving £1,000. You can build this up gradually. Remember as well, this doesn't have to cover all of your expenses. This is literally just your essential expenses that you need to survive. The next step is high interest debt. Now, mathematically, it makes more sense to pay off that high interest debt first before building up your emergency fund. And that's partly why I said just to build up 1 month to start with, because I think the psychological element is so important here. But if you have high interest debt, it's important to look at what you can do in terms of consolidating. Can you do transfers? Look at whether you can move that to a lower interest rate or even 0% rates. You will pay a small upfront fee, but you could save a lot of money in the long run. You can see paying off debt as a guaranteed investment. Whatever that interest rate is, it could be up to 20%, 30%. That's a guaranteed return on your money. By paying down that debt, you're essentially getting that money back. There's a couple of different ways that you could look at paying down the debt. You've got the snowball method and the avalanche method. The snowball method is where you rank all of your debts by the size of them and you tackle the smallest first. This is all about building momentum. So this is all about the psychological element, that if you can tick those debts off, you feel like you're moving forward and you're getting there. The avalanche method on paper is the fastest way to pay down your debts, because this is where you rank it by the interest rate and you pay off the highest interest debt first. I did do a video recently talking through these two methods in more detail if you want to check that out. Then we've got pension match. So this is where your employer is going to match your contributions into your pension. This is going to be one of the best returns on your money you're ever going to get. Saving into a pension is so important, and it's so important that you start as early as you can. Someone saving at 25 compared to someone saving at 35 will have almost double the amount of money in their pension come retirement age. In the UK, if you contribute 5% into your pension, your employer should contribute an extra 3% as well. It could even be higher than that. In previous jobs, I've had it as high as where they've contributed 10% plus matching up to 5% of what I've contributed. So I contribute 5% and actually get 20% going into my pension. You also get tax relief on your contributions going into your pension because it comes out of your gross salary, which is why it's going to be one of the best returns on your money you're ever going to get. Next is insurance. And this is one that probably doesn't get talked about enough. For most people, we're familiar with home insurance, but your most valuable asset isn't actually your home. It's you and your future earning potential. You have to think about what happens if you get ill and you're unable to work. Now, this is very specific to each individual. It depends on how many dependencies you have, what liabilities and what other people have you got relying on you. In the UK, we're twice as likely to have insurance for our pets than we are for ourselves. Your employer may offer some protection, but most often it's not enough. So a few to consider would be life insurance, death in service, family income benefit, income protection, and critical illness cover. Like I said, this is very individual, and that's why it's hard to give general advice. But mainly my point is about just having a look, get some quotes and see what's best suited to your individual situation. Then we've got tax efficient accounts. So in the UK, that'll be utilizing something like an ISA. In the US, it'll be utilizing something like a Roth IRA. This is where you want your investments to be sheltered from tax, namely capital gains tax and income tax. In the UK, you can put up to £20,000 per year into a stocks and shares ISA. Think about index funds. Think about whether you want a global approach, whether you want to be more specific, for example, going into the S&P 500. But have the majority of your money in passive investments. Have it in those index funds that you don't have to touch, you don't have to think about, and it's just going to track the performance of the stock market. If you can, automate your investing so you're contributing on a regular basis. It could be monthly, weekly, or even daily. But by having a consistent approach where you're investing regularly, you're going to smooth out any volatility. You're not having to time the market. And it also means you have more of a hands-off approach and you can invest long-term without having to think about it too much. Then we've got junior ISA and junior SIP. This is all about setting your children up for the future. I put this here because it's just like when you're on a plane and they say, put your mask on before you help others. It's important to have your own finances in check first before you start thinking about investing for your children. With the junior ISA, you can invest in this from birth, and at the age of 18, they can then access that money. You can invest in this exactly the same way that you invest your own money. It makes sense, again, to have a bit more of a passive approach in index funds, whether it's a global approach or other index funds. but have that long-term approach, and over 18 years, that could grow into a substantial amount of money. A junior SIP takes this one step further. This is a self-invested personal pension. And again, you can invest in this from birth. You get tax relief 20%, and this is creating a pension pot for when they come to retire. You can imagine over that long period of time how much that could potentially grow. Next, we've got overpay your mortgage. Now, I've put this here because this is very much a personal choice. This is so much more about a psychological element. On paper and mathematically, it makes more sense to invest into the stock market. You're going to get much better returns over the long run than you generally would paying off your mortgage. It'll all depend on the terms of your mortgage, the interest rate that you've currently got, how long you're locked in for, how much you're actually borrowing in the first place. It makes sense to maximize the other areas that we've already discussed before looking at this, but there is a massive psychological element here. It's that peace of mind, just like reducing any kind of debt, living in your house mortgage free, not having that liability. For some people, that's more important than getting a few extra % on their investments. So that's a personal decision that you have to make. Then we've got speculative investments. Now this can cover such a wide range of things. And this is a bit more for a more active investor. But this could be things like crypto, single stocks, crowdfunding. This is where you can have a little bit more fun. You can allocate a small percentage of your portfolio knowing that you've already covered all the basics. You've got that emergency fund, you've got your long-term savings investments. You've allowed yourself the opportunity to chase some potential high returns. Yes, you're going to take on a little bit more risk, but you've already got the basics covered. I would still have a long-term approach with these. I wouldn't go chasing returns after 6 months, for example. Still have that 5-year time horizon, but play around with it, have a little bit of fun. It could just be 10% of your portfolio. Some of these things in this list can be done at the same time. You can almost look at them as tiers rather than having to work through each individual one first. For example, like building up your emergency fund. Like I said at the start, it was important just to create that first month first. And then as you're moving through each of the other levels, you can gradually add to that emergency fund. So you eventually get to that 3 to 6 months. Each month that you have is not always going to be the same as well. You may get a salary, but you may get a bonus as well. You may have different expenses throughout the year. So it's important to have an open mind and a balanced approach. I hope that helped. Thanks for watching. I will catch you in the next one.